You know, usually when we talk about getting a medical diagnosis, there is this expectation of just, well, sheer, almost mechanical precision.
Right. You want a definite answer.
Exactly. You fall, your arm hurts, you go in, and the x-ray shows that jagged white line. The doctor points at the screen and says, there it is.
Yeah, it's undeniably comforting to have that binary certainty. I mean,
Huh?
we crave visibility, especially when something is obviously broken.
Right. Broken or not broken, it's clean. But then you take a step into the world of financial valuation, and it feels like, I don't know, somebody just took a sledgehammer to that x-ray machine.
That is a very accurate way to put it, actually.
Yeah, because we are looking at a diagnostic landscape that is, well, it's incredibly murky. You're trying to figure out if a stock is actually worth its asking price, or if the entire market is just suffering from some collective delusion.
And there is no single machine you can just, step into that prints out a piece of paper saying, yes, buy this, or no, run away.
Yeah. Right, exactly. Which
Yeah.
is entirely the mission for this deep dive. Today, we are unpacking a stack of notes that acts almost like a survival guide for navigating that exact murky landscape.
And if there were such a machine, by the way, the market wouldn't even exist.
Yeah.
I mean, the market is entirely built on differing opinions of what that true value actually is.
That's a great point. So for you listening, we've got our hands on a dense but incredibly practical synthesis of financial analysis. Specifically, we are diving into the CFA Level 2 Schweizer notes focused on market-based valuation, so price and enterprise value multiples.
I actually find this specific area of study really compelling. It forces you to bridge the gap between, high-level academic financial theory and the gritty minute-by-minute reality of what traders are actually doing on the floor.
Yeah, it's where the rubber meets the road.
Exactly.
Yeah.
It really is.
And for you tuning in, whether you are putting together a pitch book for a major investment meeting or, trying to decode why your own retirement portfolio is behaving a certain way, or maybe you just want to know how the biggest institutions on Wall Street decide what a company is worth, this is basically the toolkit.
It's the essential toolkit.
Because the core problem we are tackling is simple to state, right? But it's so hard to solve. How do you know if a stock is cheap or expensive?
Which is the million-dollar question, literally.
Literally. And we've talked in the past about building out massive discounted cash flow models, projecting out decades of cash flows, finding the perfect discount rate.
Right, the really heavy lifting.
Yeah, but let's be honest, that takes an eternity. And the assumptions you have to make can just be wild. So today is all about the shorthand, the multiples.
I would actually caution against leaning too heavily on that word shorthand, though.
Oh, really? Why is that?
Well, while price multiples might appear to be simple shortcuts, I mean, you are, after all, just dividing one number by another. They are remarkably complex instruments.
Okay, that's fair.
Yeah, used correctly, they can reveal subtle mispricings, showing you whether a stock is overvalued or undervalued relative to its peers, or even its own history. But if you just grab a ratio without understanding the accounting underneath it,
You're basically driving blindfolded.
exactly, you're driving blindfolded straight into a ditch.
Okay, let's unpack this safely then. Before we even touch a specific ratio, the notes really hammer home a foundational distinction in market-based valuation.
Yes, this is crucial.
We need to define the difference between the actual price multiple and the justified price multiple.
This is the bedrock of everything we're about to discuss today. The actual price multiple is simply a reflection of current market reality.
So what does that mean in practice?
It means if you open your brokerage app right now, look at a stock's price, and divide it by a metric like its earnings, you have calculated the actual multiple.
It's just the raw data.
Right. It doesn't care about theory at all. It just tells you what people are currently paying right this second.
Okay, so if I walk into a store, it's what the price tag on the shirt says. $50. That's the actual price.
Yeah, that's a perfect analogy. The justified price multiple, conversely, is what that multiple should be if the stock were perfectly and fairly valued based on its fundamental financials.
Based on the real underlying business.
Exactly. We are talking about its true growth rates, its inherent risk profile, its expected cash flows over time.
So following the analogy, the justified multiple is what the materials, the labor, and, a reasonable profit margin say the shirt is actually worth.
Right.
Maybe it's realistically a $20 shirt, but it has a $50 price tag.
Exactly. And that gap between the 20 and the 50, that gap is where the money is made or lost in the market. The entire discipline of market-based valuation comes down to comparing those two distinct numbers.
So if the actual multiple the market is demanding is greater than your calculated justified multiple,
Then you're looking at an overvalued asset. You are paying for a brand name or hype or momentum, but the fundamentals just don't support it.
Got it. And if the actual multiple is less than the justified multiple, you've found something on sale.
Yes, the market has underpriced it relative to its true potential.
That sounds great in theory.
It is. The challenge, of course, is that calculating that justified multiple requires a lot of assumptions.
Well, let's dive into the metrics themselves and see how those assumptions actually play out. Let's start with the undisputed heavyweight champion of the financial world.
Oh, we all know this one.
Yeah, even if you only passively listen to the business news while you drink your morning coffee, you have heard this term, the price-to-earnings ratio, the PE.
It is the most ubiquitous valuation tool in equity markets, bar none.
Let's lay out the math from the sources for everyone. It's the market price per share of the stock divided by the earnings per share, or EPS.
Simply price divided by earnings.
Right. The way I always internalize this is, you're essentially asking the market, how much am I being forced to pay today to buy exactly $1 of this company's earnings?
That is the perfect framing, and the rationale for its dominance is actually quite solid. An enterprise's earning power, which we measure via EPS, is generally accepted as the primary driver of its long-term investment value.
Makes sense. Earnings are what keep the lights on.
Furthermore, because absolutely everyone uses it, the PE ratio functions as a universal language. You can sit down with an investor from Tokyo, London, or New York, say a stock has a PE of 15, and you immediately have a shared baseline.
The notes also mention that empirical research backs this up, right? Historically, differences in PE ratios are significantly correlated with differences in long-run average stock returns.
They are, yeah. Though I'd add the caveat that those historical correlations do shift depending on the macroeconomic environment.
Yeah.
But as a baseline, yes, the empirical data supports its utility.
But immediately, the sources throw a massive curveball. You can't just walk into a meeting, declare a stock's PE, and drop the mic.
No, absolutely not.
You have to specify your timeline. We have trailing PE and leading PE.
And failing to make that distinction is, well, it's one of the most common errors novice investors make.
Break it down for us.
So a trailing PE uses the earnings per share generated over the previous 12 months. It is purely historical.
It's in the rearview mirror.
Right. It is an audited, factual record of what actually happened.
Whereas the leading PE, which I sometimes see called the forward PE, uses the forecasted earnings per share over the next 12 months.
Yes. You basically swap out the historical fact for an analyst's projection.
I want to walk through the concrete example the text provides because the math really illustrates why this distinction matters so much.
Okay, let's do it.
Let's look at this hypothetical company, Byron Investments. I'm going to run the numbers here. So Byron reported 32 million euros in total earnings during their current fiscal year.
Okay.
They have 40 million shares outstanding in the market. And the stock price today is 18 euros per share.
Let's isolate the trailing numbers first.
Okay, so step one is figuring out the trailing EPS. I take the 32 million in total earnings and I divide it by the 40 million shares.
Right.
That gives me an EPS of 80 cents, 0.80 euros in historical earnings per share.
So far, so good.
Next, to find the trailing PE, I take that current market price of 18 euros and I divide it by the 80 cents. 18 divided by 0.8. That gives a trailing PE of 22.5.
Meaning investors today are paying 22.5 times the earnings the company just generated last year.
Which, depending on the sector, might feel a bit rich, right?
It might. But let's introduce the forward-looking aspect. Let's say the consensus among analysts is that Byron's EPS over the next 12 months is going to grow. They aren't going to make 80 cents. They're going to make a clean €1 per share.
Oh, okay, so the math shifts. The numerator, the price stays at 18 euros because that's what it costs to buy the stock right now.
Exactly. The price is always today's price.
But the denominator changes to the forecasted €1. So 18 divided by 1 is just 18.0. So our leading PE is 18.0.
This perfectly illustrates the psychological gap between the two metrics. If a portfolio manager only screens for trailing PE, they see a 22.5 multiple and might automatically discard Byron Investments as too expensive.
Because it's over their threshold.
Right. But if they trust the analyst's forecast, the leading PE of 18.0 suddenly makes the stock look significantly more attractive relative to its future earning power.
Because the market is inherently a forward-looking mechanism. I mean, we don't buy stocks for what they did yesterday. We buy them for what we think they'll do tomorrow.
That's the fundamental truth of equity markets, which is exactly why leading PE is so frequently the preferred metric in professional analysis. However, it requires a massive leap of faith.
You have to trust the
You have
forecast.
to trust that projection completely.
And this is where I have to push back, or at least channel my inner cynic. Earnings can be manipulated, right? We've seen the documentaries, we've read the postmortems of corporate collapses.
Enron, WorldCom, the list goes on.
Exactly. Management teams are heavily incentivized to play accounting games to make that EPS number look as attractive as possible. So how can we base our core valuation on a number that a company's creative accounting department can just, massage?
You are highlighting the most significant vulnerability of the PE ratio. The notes explicitly call this out as a major disadvantage. Management discretion can, and frequently does, distort reported earnings.
It's kind of terrifying.
It is. Furthermore, even if management isn't acting maliciously, let's say they're completely honest, a volatile, transitory portion of earnings can make interpreting the PE incredibly difficult.
Okay, give me an example of a transitory earning. What does that mean?
Well, suppose you are analyzing a regional retail chain. They have steady, boring earnings most years. But one year, they decide to sell a massive piece of prime real estate they've owned for 50 years.
Oh, I see where this is going.
Right. Their earnings for that specific quarter will absolutely skyrocket because of the capital gain from that real estate sale.
But they can't sell that land again next year. It's a one and done.
Precisely. So if you calculate a trailing PE using that inflated earnings number, the PC will look incredibly low. The stock will look like the bargain of the century.
Because the denominator is artificially huge.
Yes, but it's an illusion. The actual core business of selling goods hasn't improved at all.
So calculating the raw PE ratio is just basically middle school math. The actual art of the analyst is figuring out what number to put in the denominator in the first place.
Exactly.
The notes talk about estimating underlying earnings.
Yes, also referred to as persistent, continuing, or core earnings. This is the agonizing process of scrubbing the income statement.
Scrubbing it, like line by line.
Line by line. Analysts have to manually back out non-recurring components. You exclude gains and losses from asset sales. You ignore massive one-time asset write-downs. You adjust for unusual provisions for future losses.
And strip out the effects of changes in accounting estimates.
Yes, it's a lot of work.
So if our retail chain reported an EPS of $3, but $1.50 of that was from the real estate sale, their true underlying earnings are only $1.50.
Right. You value the company based on the $1.50 because that's the repeatable engine of the business.
That's the discipline required. And it gets even more complex when dealing with cyclical industries, doesn't it? The text introduces another adjustment called normalized EPS.
Right. For companies whose earnings are tied heavily to the broader economy. Let's think about a heavy machinery manufacturer like Caterpillar or John Deere.
Okay.
In a booming economy, everyone is building, their machines are flying off the lot, and their EPS is enormous. But in a recession, construction halts, and their earnings crater.
So if you just look at their PE during a boom, their earnings are so high that the PE multiple looks artificially low. It basically lures investors into buying right at the absolute top of the cycle.
Which is a trap. And conversely, during a trough, their earnings are tiny, making the PE look massive, which terrifies investors into selling right at the absolute bottom when the stock is actually cheapest.
So how do analysts smooth that out? How do you calculate a normalized EPS to avoid those traps?
The sources outline two primary methods. The first is fairly intuitive. You use the historical average EPS over the course of a full, complete business cycle.
So you just add up the boom years and the bust years and find the middle ground.
Pretty much.
I can see a flaw in that immediately, though.
Oh.
What if the company has fundamentally changed its size? Say they doubled their manufacturing capacity 3 years ago. Their historical average from 8 years ago is completely irrelevant to their current earning power.
You've identified the exact reason why the notes actually prefer the second method. The preferred approach uses the average return on equity, or ROE.
Walk me through how that one works.
Instead of averaging the raw earnings, you look at the company's historical ROE over a full business cycle. ROE is a ratio of profitability, so it scales with the size of the company.
Okay.
You calculate that historical average ROE, and then you multiply it by the company's current book value per share.
Oh, wow, that's clever. Because the current book value represents the size the company is today.
Exactly.
So you are essentially saying, assuming this company generates its historical average level of profitability on the assets it holds right now, what would its earnings be?
It beautifully isolates the cyclical noise while respecting the company's current scale. It gives you a much more robust normalized denominator for your PE calculation.
I love how analytical that gets. But let me throw a completely different wrench into the machinery.
Go for it.
What happens when a company is just straight up losing money? Like if earnings are negative, the math of a PE ratio completely breaks down. I mean, I am paying negative 5 times earnings for this stock. It's gibberish. Does the valuation model just throw an error code?
It doesn't break the system entirely, but it does force a change in perspective. When the denominator goes negative in a PE ratio, you're right, the comparative value is lost. The solution the text provides is to simply flip the fraction upside down.
Which gives us the earnings yield.
Yes,
Thank you.
EP ratio, earnings divided by price.
It's a very elegant mathematical workaround. Because a stock's market price can never fall below zero, your denominator in an EP ratio is always a positive number.
Always.
Let me conceptualize that. If a company has negative earnings of, say, negative $2 per share, and the stock is trading at $20, a PE would be negative 10, meaningless. But an earnings yield would be negative $2 divided by $20, which is negative 10%.
And negative 10% is a highly usable, mathematically sound number. It tells you that for every dollar you invest, the company is currently losing 10 cents.
How does this help us in the broader context of the market, though? I mean, a negative yield is still bad, right?
It is bad, of course, but it solves a massive logistical problem for quantitative analysts. Imagine you are managing a global fund and you run a computer model to rank 3,000 securities from the absolute cheapest to the absolute most expensive.
Okay.
If you use PE, all the companies losing money return an NA, or a mathematically useless negative number that breaks your sorting algorithm. Where do you put them?
Oh, I see. They just fall out of the model. But if you use earnings yield, the highly profitable, cheap companies have high positive yields. The expensive companies have low positive yields. And the companies bleeding cash drop seamlessly to the very bottom of the list with negative yields.
Exactly. It preserves the continuum of valuation. High EP means a cheap security. Low or negative EP means an expensive or distressed security. It allows the mathematical ranking to proceed uninterrupted.
That is a fascinating peek behind the curtain of quantitative modeling. But, a few minutes ago we were talking about how much effort goes into scrubbing the income statement to find underlying earnings.
Yes, the endless adjustments.
Right. Sometimes a company's income statement is just a disaster zone of accounting adjustments. Or maybe the industry's so opaque you just don't trust the earnings number at all, no matter how much you normalize it.
And when the income statement loses its credibility, analysts seek refuge in the balance sheet.
Which brings us to the price-to-book ratio, or PB. It feels so much more grounded. We aren't looking at theoretical flows of money over a year. We are looking at the actual stuff the company owns.
The PB ratio is a cornerstone of traditional value investing. We are taking the market price per share and dividing it by the book value of equity per share.
Let me make sure I'm defining book value correctly for everyone listening. Book value of equity is essentially what the accountants say the company is worth if you stopped operations today. It's the total assets, the buildings, the cash, the inventory, minus the total liabilities, the debts, the obligations. Whatever is left over belongs to the shareholders.
That's the conceptual foundation, yes. It's the net asset value. And there are substantial advantages to using PB, especially when earnings are problematic. The primary advantage is that book value is cumulative.
Meaning it builds up over time.
Yes. Because it is the accumulation of retained earnings over the life of the company, it is usually a positive number, even if the company is currently suffering through a terrible year and reporting negative EPS.
But you can always use it.
Right. Therefore, you can almost always calculate a meaningful PB ratio, even when a PE ratio is useless.
So a company might lose millions this year, but because they made billions over the last 2 decades, their balance sheet is still massively positive.
Exactly. Furthermore, that cumulative nature makes book value far more stable than earnings per share. EPS can swing wildly from quarter to quarter based on sales fluctuations or raw material costs. Book value moves like a glacier.
Nice visual.
Thanks. It provides a much steadier anchor for valuation when earnings are highly volatile.
But I imagine you can't just apply price to book to every stock in the S&P 500 and call it a day. There have to be limitations.
Severe limitations. The notes are emphatic about when PB is actually an appropriate tool. It is the gold standard for valuing firms whose assets are primarily liquid. We're talking about the financial sector, banks, insurance companies, investment firms.
Let's break down why that is. If I look at a bank, their assets aren't factories or complex supply chains. Their assets are mortgages, treasury bonds, and cash.
And importantly, accounting rules dictate that those financial instruments are regularly marked to market, or they are held at values that closely approximate their fair market value.
So they reflect reality.
Yes, if a bank holds a portfolio of government bonds worth $500 million, the book value of those assets is $500 million. The accounting reality and the economic reality are closely aligned.
Okay, now let's contrast that with a software company, or maybe a pharmaceutical giant.
This is where PB fails spectacularly.
Why is that?
Think about a pharmaceutical company. They might spend 10 years and $2 billion in research and development to invent a new cancer drug. Under accounting rules, much of that R&D is expensed as it occurs. It doesn't build up as a massive asset on the balance sheet.
But once the drug is approved and patented, that patent might be worth $50 billion in future revenue.
Yet the book value of that patent on the balance sheet might be close to zero. The company's true economic power is entirely divorced from its accounting book value. The book value ignores human capital, brand equity, brilliant software code, and incredibly valuable intangible assets.
So if you try to value a tech company using PB,
You will assume it is wildly overvalued, completely missing the actual drivers of its worth.
that makes perfect sense. PB for tangible, liquid assets, find something else for intangibles. Let's look at the data from the sources to see how an analyst actually uses PB in the field. We have a comparison here between two hypothetical companies, Crisco Systems and Soothsayer Corp. Let's run the Crisco numbers first.
The text gives us a total book value of equity for Crisco of $28,000 to $39. We can assume that's in millions, but the scale doesn't really matter for the ratio.
Right, and they have 7,001 shares outstanding.
Okay, doing the math. I divide the total book value, $28,039, by the 7,001 shares.
That gives me a book value per share of $4.01. So according to the accountants, every share of Crisco is backed by $4.01 of net assets.
Now compare that to what the market is demanding. The current market price of Crisco is $17.83.
Okay, so I divide the market price, $17.83, by the book value per share, 4.01. That gives me a price-to-book ratio of roughly 4.45 times. Investors are paying $4.50 for every dollar of net assets.
Now let's process the competitor, Soothsayer Corp.
Soothsayer has a total book value of equity of $6,320, with 5,233 shares outstanding. Dividing those gives me a book value per share of $1.21.
And their stock is currently trading at $12.15.
So 12.15 divided by 121, that is a PB ratio of 10.04 times.
This is the power of relative valuation. If you only looked at the stock prices $17.83 versus $12.15, you might assume Soothsayer is the cheaper stock.
Right, because the price is lower.
But when you look at the PB ratio, the reality flips entirely. Crisco is trading at 4.45 times its book value, while Soothsayer is trading at over 10 times its book value.
If these were two regional banks with similar risk profiles, you would immediately flag Crisco as potentially undervalued relative to Soothsayer because you are getting way more underlying assets for your investment dollar.
It acts as an incredibly fast, highly effective screening mechanism to find disparities in the market.
It's a fantastic reality check. But I want to circle back to the blind spot we just discussed regarding tech companies.
The intangibles.
Yeah. What if I am trying to value a Silicon Valley startup? They rent cloud servers, their workforce is fully remote, they own no real estate, and they are intentionally burning through cash to acquire users, so their earnings are deeply negative.
So PE is useless and PB is useless.
Exactly. Their book value is practically non-existent, and their earnings are negative. How do you value a company that is essentially just an idea growing incredibly fast?
You have to move to a metric that focuses purely on growth and market penetration, ignoring profitability and asset bases entirely. You use the price-to-sales ratio, or PS.
Ah, the unmanipulable metric. The holy grail of the growth investor. Let's define it. The formula is the market price per share divided by the sales per share. Or, if you prefer looking at the whole pie, it's the total market capitalization divided by total sales revenue.
The appeal of the PS ratio really lies in the purity of the top line. Revenue is the oxygen of a business. And the most glaring advantage, as the notes point out, is that sales revenue is always positive.
Unless a company has a business model where they physically hand out money and refuse to accept it, which seems, unlikely.
Exactly. Even a distressed company on the verge of bankruptcy or a hyper-growth startup bleeding cash daily will report positive sales revenue as long as it has actual customers.
True.
Therefore, the PS ratio provides a mathematically meaningful valuation multiple for almost any operating business, regardless of their current profitability status.
I've always liked thinking about this using a social media analogy.
Let's hear it.
Think of earnings per share, the EPS, like a heavily filtered photo on Instagram. By the time it reaches the public, the accountants have gotten their hands on it. They apply depreciation filters to soften the edges. They adjust the lighting with amortization schedules. They crop out non-recurring losses to make the background look better.
I like this.
The EPS looks pristine, but you wonder how much it really represents reality. Sales revenue, on the other hand, is the raw, unedited camera roll. You just open up the cash register and look at the receipts. You can't filter it. You can't hide what is or isn't actually coming through the front door.
That's a very vivid way to describe accounting discretion. The Schweizer notes echo that exact sentiment, albeit with slightly less colorful language. They state clearly that sales revenue is simply not as easy to manipulate or distort as EPS and book value.
It's harder to fake.
Right. You can have endless debates with an auditor about the useful life of a piece of manufacturing equipment and how fast it should depreciate. It is much harder to debate whether a customer transferred funds into your account for a product.
It's a statement of empirical fact. Did the money come in or not?
Furthermore, PS ratios tend to be significantly less volatile than PE multiples. Because revenue isn't subject to the wild leverage effects of fixed costs that impact net income, PS provides a much smoother, more reliable valuation anchor.
Especially when analyzing a company whose earnings in a particular year are anomalously high or low. So strategically, beyond just startups, where do analysts actually rely on PS?
Startups and early-stage SaaS companies are the classic use case. But the notes also highlight its utility in mature, cyclical industries.
Like the heavy machinery manufacturer we mentioned earlier.
Exactly. Think back to our auto or machinery manufacturer during a recession. Their earnings are negative, but their sales revenue still provides a very accurate picture of their market share and operational footprint. It tells you they are still a major player, even if they aren't profitable right now.
The text also specifically mentions investment management companies and partnerships as prime candidates for PS valuation.
Yes, it works well there too.
But there is a massive glowing red warning light on the dashboard here. And I think anyone who has ever run a small business is probably screaming this at their speakers right now.
What's up?
Sales do not pay the bills if your expenses are completely out of control. I mean, I could generate $1 billion in sales tomorrow if I sold $1 billion worth of gold for 50 cents on the dollar.
You'd have a massive top line.
My PS ratio would look amazing, but I'd be bankrupt by Tuesday.
You've identified the fatal flaw. The price-to-sales ratio completely ignores cost structure, operational efficiency, and actual profitability.
Right, it's blind to costs.
Completely blind. If Company A and Company B both have $1 billion in sales and trade at identical PS ratios, they look identical to the screener. But if Company A has a 40% profit margin and zero debt, while Company B has a 2% profit margin and billions in high-interest debt, treating them as equally valued is a disastrous mistake.
So relying solely on the top line is dangerous. And we already established that trusting the heavily filtered bottom line of earnings is risky. If we really want to understand the health of an enterprise, we can't look at theoretical revenues or accounting profits. We have to follow the actual money. We need to follow the cash.
Which transitions us perfectly to the most unvarnished metric available, price to cash flow, or PCF. Cash is the lifeblood of the entity. You can aggressively recognize revenue, you can hide expenses and depreciation, but you absolutely cannot fake the balance of the cash in your corporate bank account.
Cash is reality. But reading through the notes, the complication here isn't the theory, it's a definition. Cash flow isn't just one universally agreed upon number.
No, it is not.
The sources outline 4 distinct ways analysts calculate the denominator for this ratio.
Yeah.
Let's debate these because this feels like where the serious granular financial analysis actually takes place.
It definitely is. The choice of cash flow metric can completely alter your valuation perspective. Let's start with the most basic approach, earnings plus non-cash charges.
Okay, this feels like a shortcut. You start with the heavily filtered EPS number, and you just add back the per-share depreciation, amortization, and depletion.
The logic being depreciation is an accounting fiction.
Right. I didn't write a check for depreciation this year. I bought the machine 5 years ago.
Yeah.
So I add that non-cash expense back to my earnings to get closer to my true cash generation.
It is a shortcut, and while it's widely used because the numbers are easily accessible right there on the income statement, it's a very crude proxy.
Right, crude.
It ignores changes in working capital. Like, what if the company suddenly had to buy a massive amount of inventory, tying up their cash? This metric misses that completely. It's an approximation, not the real thing.
Which naturally leads analysts to the second definition, cash flow from operations, or CFO.
CFO is a significant step up in accuracy. You don't approximate it, you pull it directly from the cash flow statement. It represents the actual cash explicitly generated by the core business operations.
So it captures the working capital changes?
Yes. Analysts will typically take this CFO number and scrub it further, subtracting any non-recurring cash flows to find the sustainable run rate. The text is very clear that using CFO is more technically correct than the simple earnings plus non-cash charges method.
So CFO is better, but then we have the third definition, which I often hear referred to as the holy grail of valuation, free cash flow to equity, or FCFE.
FCFE is conceptually the most robust metric we have. It represents the actual cash that is available to be distributed to the equity shareholders after every single obligation has been met.
It's what's truly left over.
Exactly. It's the cash left over after operating expenses, after investing in necessary fixed capital, we call capital expenditures or CapEx, and after issuing or repaying debt.
The formula provided in the notes is CFO minus CapEx plus or minus net borrowing.
Correct. The notes emphasize that FCFE is the measure most deeply linked to pure value theory. It answers the ultimate shareholder question. If the business continued running as it is, how much cash could management legally hand to me today without impairing operations?
Okay, if FCFE is the theoretical gold standard, why are there 4 definitions? Why do we bother with the other 3? Let's just use FCFE for everything.
Because the real world is incredibly lumpy. FCFE is notoriously volatile, specifically because it subtracts capital expenditures.
Lumpy. I like that. Give me an example.
Imagine a highly profitable shipping company. They generate massive cash flow every year. But this year, they decide to modernize their fleet and buy 5 new cargo ships. Their CapEx for this specific year will be astronomical.
Oh, I see. Which means if you subtract that massive CapEx from their operating cash flow, their FCFE for this year might drop to 0 or even go deeply negative.
Exactly. If you calculate a PCF multiple using that single year's FCFE, the company looks like it's in a death spiral, failing to generate cash.
But the reality is they are just making a massive one-time investment that will fuel growth for the next 20 years.
It's a timing mismatch.
Got it.
The text warns analysts about this specific volatility. It suggests that if you are going to use FCFE, you frequently need to use an average FCFE over several trailing or forecasted years. You have to smooth out those lumpy capital investments to get a true picture of the underlying cash generation capability.
Okay, that leaves the 4th and perhaps most heavily debated definition of cash flow mentioned in the text, EBITDA, earnings before interest, taxes, depreciation, and amortization. I feel like every time I read a press release for an acquisition, they quote an EBITDA multiple.
EBITDA is incredibly pervasive, particularly in the realm of mergers, acquisitions, and private equity. It represents the raw operational cash flow of the business before the government takes its tax cut, before the lenders take their interest payments, and before the accountants apply their depreciation math.
I want to defend EBITDA for a second. It seems like the purest way to evaluate just the business itself.
How you mean?
Well, if I want to buy a bakery, I just want to know how much cash the ovens and the bakers generate. I don't care how the current owner financed the ovens, whether he used debt or equity. That's his problem. EBITDA strips away the capital structure and just shows me the raw earning power of the bakery.
Your defense highlights exactly why private equity loves it. It allows them to evaluate the core asset. But I'd caution you, relying too heavily on EBITDA has led to some of the most spectacular financial disasters in modern history.
Wait, really? How so?
Because it completely ignores capital expenditures. Remember the dot-com crash? Telecom companies were trading at massive EBITDA multiples. Their operating cash flow looked incredible.
Right.
But EBITDA ignores the fact that those companies had to spend billions of dollars every single year laying fiber optic cable just to stay competitive. They were operationally profitable, but they were bleeding total cash because their CapEx requirements were infinite.
Wow, so the operational profit was just a mirage?
Exactly. Warren Buffett famously despises EBITDA for this very reason. He asks, does management think the tooth fairy pays for capital expenditures?
That is a phenomenal reality check. EBITDA is the raw engine power, but it ignores the cost of maintaining the engine.
Well put.
Still, as you mentioned, it is the standard in M&A. And discussing EBITDA leads us to a massive conceptual shift in the notes. You don't generally use EBITDA to evaluate a single share of stock. You use it when you want to buy the whole pie. We have to move from equity multiples to enterprise value
This
multiples.
is a critical leap in valuation logic. Everything we have unpacked so far, PE, PB, PS, PCF, these are all equity multiples. The numerator is the price of a single share of stock.
Right.
They are designed for a minority investor looking to buy a piece of the equity. But if you are a corporate acquirer, you don't want a piece. You want the whole company. And to calculate that cost, you must calculate its enterprise value, or EV.
Let's explicitly define the EV formula as laid out in the notes. It is the market value of the equity, which is simply the current stock price, multiplied by the total number of outstanding shares, plus the market value of the company's debt, minus cash and short-term investments.
Let's pause and dissect that because the mechanics of that formula often confuse people. Adding the debt makes intuitive sense to most.
Right. If you buy a company lock, stock, and barrel, you are assuming its liabilities. You now owe the bondholders. The debt is part of your total acquisition costs.
But subtracting the cash, why do you subtract the target's cash when valuing the enterprise? Doesn't a massive cash pile make a company more valuable?
I struggled with this for a long time until I heard it framed as a real estate transaction. Imagine you are buying a fully furnished house. The asking price is $500,000. That is the market value.
Okay, I'm following.
You tour the house, and as you walk through the kitchen, you notice the current owner has left stacks of crisp $100 bills on the kitchen counter, totaling $50,000. And the purchase contract stipulates that if you buy the house, you get to keep everything inside, including the cash.
I like this framing. Proceed.
So you go to closing, you write a check for $500,000. But the moment you take possession, you walk into the kitchen, scoop up that $50,000 and put it directly back into your own pocket.
Nice.
What was your net economic cost for acquiring the house? It wasn't $500,000. Your true net out-of-pocket cost was only $450,000. The cash you acquired essentially subsidized your purchase price.
That is an absolutely flawless analogy. The Schweizer notes state this exact principle. The rationale for subtracting cash and investments is that an acquirer's net price paid for an acquisition target would be lowered by the amount of the target's liquid assets.
So it's not a measure of total worth?
No, enterprise value isn't a measure of total worth. It's a measure of the true net economic cost of buying the entire operational business structure.
Okay, that clarifies the numerator, the EV. But why is it universally paired with EBITDA? Why EBITDA? Why not calculate an EV to net income ratio?
This comes down to a fundamental golden rule of financial ratios. The numerator and the denominator must match in terms of the stakeholders they represent.
What does that mean?
Well, net income, the bottom line earnings belongs exclusively to the equity shareholders. The debt holders have already been paid their interest out of the operating cash flow. Therefore, you must compare net income to the equity price.
Right, that's the PE ratio, equity value on top, equity cash flow on the bottom, apples to apples.
Exactly. But EBITDA, as we discussed, is earnings before interest. It is the massive pool of raw cash flow available to pay both the equity holders and the debt holders.
I see.
Because the denominator EBITDA represents a cash flow stream belonging to both groups, it is mathematically required to be compared to a numerator that also represents both groups. That numerator is enterprise value, which explicitly includes both the equity and the debt.
The symmetry is beautiful. If you calculated EV to net income, you would be taking a whole company value on top and comparing it to an equity-only cash flow on the bottom. It would be a complete mismatch, distorting the valuation.
It would be functionally meaningless. This stakeholder alignment is why EBITDA is the gold standard for total firm buyouts. It allows an acquirer to strip away the arbitrary decisions a target company made regarding its capital structure.
So it levels the playing field.
Yes. If Company A chose to fund itself with heavy debt and Company B chose to issue equity, their PE ratios will look vastly different because of the interest tax shields. But their EV/EBITDA ratios will allow an acquirer to compare their core operating engines on a perfectly equal footing.
Okay, let's take a collective breath here. We have just unpacked a massive utility belt of valuation metrics. We have the PE ratio for evaluating raw earnings power. We have PB for anchoring to hard balance sheet assets, PS for unmanipulable revenue growth, PCF for following the raw money. and EBITDA for evaluating the total acquisition cost of the enterprise.
A lot of tools.
We know how to calculate them, and we know when to use them. But it begs a deeper question. What fundamentally drives these multiples?
That is the core question.
Why does the market decide that company X deserves a PE of 10, while company Y deserves a PE of 50? Is it just market sentiment, or is there a mathematical engine underneath?
It is absolutely driven by a mathematical engine. And this is where the notes transition from merely observing market multiples to understanding the fundamental mechanics dictating them. The text connects these price multiples directly back to fundamental discounted cash flow factors, primarily using the framework of the Gordon growth model.
The Gordon growth model. That's the classic foundational formula for perpetuity, right? Value equals the next expected dividend divided by the required rate of return minus the expected growth rate.
Yes, V equals D1 over R minus G.
Right.
And through some fairly involved algebraic manipulation, which mercifully we don't need to perform on air, you can break that model down to derive the fundamental drivers for every single multiple we've discussed. If you understand these drivers, you stop guessing and start understanding exactly how the market is pricing risk and growth.
Okay, let's map out the secret engine behind each of our core metrics based on the text's derivations. Let's start with the king. What fundamentally drives a PE ratio higher?
Assuming all else is held equal, a PE ratio is driven higher by two primary forces, a higher expected growth rate of earnings and a lower required rate of return.
That makes intuitive sense. If I believe a company's earnings are going to grow exponentially, I'm willing to pay a massive premium, a higher multiple today, to get access to that future growth. And the required rate of return represents risk. If the company is a stable blue-chip monopoly, my risk is low, my required return is low, and the math dictates the multiple expands. What about the price-to-book ratio, PB?
The fundamental engine for the PD ratio is the spread between the return on equity ROE and the required rate of return. A greater spread drives the PB multiple higher.
Let me conceptualize that. If a company is generating an ROE of 20% on its internal assets, but the market only requires a 10% return for that level of risk, the company is essentially a wealth creation machine.
It is generating massive excess returns.
Therefore, the market will price that book value at a huge premium. The PB goes up.
Precisely. You are paying a premium because management is deploying capital at a rate far superior to the market average. How about price to sales? Well, the PS ratio is fundamentally driven higher by a greater net profit margin, combined with a higher expected growth rate and a lower required rate of return.
Wait, hold on. Let's isolate that first variable, a greater net profit margin. This elegantly solves the fatal flaw we were agonizing over 10 minutes ago. We said the danger of PS is that it ignores costs. But the fundamental mathematical theory proves that profit margin is the hidden engine driving the PS ratio.
The theory perfectly corrects the flaw. If two companies generate $1 billion in sales, but one has a 40% margin and the other has a 2% margin, the fundamental models dictate that the high-margin company inherently deserves a drastically higher PS multiple. The market prices in the efficiency.
It's incredible how the theoretical math backs up the practical intuition. But let's zero in on growth, because it is undeniably the most explosive variable in these equations. The notes introduce a very specific tool to handle disparities in growth, something called the PEG ratio, the price earnings to growth ratio.
The PEG ratio is an essential tool for normalizing valuations across a universe of companies that are growing at wildly different speeds. It attempts to answer the question, is this high PE justified by hypergrowth, or is it just dangerously overvalued?
What's the formula?
It's simply the stock's PE ratio divided by its expected earnings growth rate.
Let's do a thought experiment to lock this in for the listener. Imagine two software companies competing in the same sector. Company A is trading at a PE of 30. Company B is also trading at a PE of 30.
Okay.
If you just ran a basic screen, they look identically valued.
On the surface, yes.
But then you dig into the fundamental projections. Company A is a mature business, and its earnings are growing at a respectable 10% a year. Company B, however, just released a revolutionary product, and its earnings are exploding at 30% a year. If they both cost 30 times earnings, Company B is obviously the superior investment. How does the PEG ratio quantify that intuition?
We just run the math. For Company A, you take the PE of 30 and divide it by the growth rate of 10. That gives you a PEG ratio of 3.0.
Okay, 3.0.
For Company B, you take the identical PE of 30, but you divide it by the massive growth rate of 30. That gives you a PEG ratio of 1.0.
Wow. Okay. And the general rule of thumb, which the text supports, is that lower PEG ratios are fundamentally more attractive, assuming risk and other factors are equal.
Yes, lower is better.
The PEG ratio tells you exactly how much you are paying for each individual unit of growth. Company A is charging you 3 units price for 1 unit of growth. Company B is giving you growth at a 1-to-1 ratio. It's significantly cheaper relative to its potential.
It acts as a powerful equalizer when comparing high-growth tech stocks to slow-growth value stocks. But I should note, the notes introduce a far more advanced, statistically rigorous technique for finding value: cross-sectional regression.
Cross-sectional regression, that sounds like a PhD thesis topic. It sounds intimidating.
It is heavily reliant on statistics. Quants use this to bypass theoretical models and simply ask the market what it thinks.
How does that work?
Analysts will take a massive data set, say, all 500 stocks in the S&P 500 at a single specific point in time. That's the cross-section. They then run a multivariable linear regression. They set the actual PE ratio as the dependent variable, and they input fundamental metrics like expected growth rates, dividend payout ratios, and beta as a measure of risk as the independent variables.
I think I understand. It reminds me of the algorithm Zillow uses to price houses.
Oh, how so?
Well, the algorithm looks at every house sold in your neighborhood this month. It notes that houses with 3 bedrooms, 2 baths, and a pool sell for a certain premium. Then it looks at your house, applies those premiums, and gives you a predicted price.
Yes, exactly.
You are essentially doing that with stocks. You are asking the algorithm, based on exactly how the market is valuing growth, risk, and dividends for every other company today, what should the PE of this specific company be?
That is a brilliant analogy. The regression equation generates a predicted PE based entirely on the empirical reality of the current market environment. You then compare that predicted PE to the stock's actual PE.
So if the regression model says company X should have a PE of 25 based on its stellar growth and low risk, but the stock is currently languishing with an actual PE of 15, the model is flashing a massive BUY signal. It's empirically undervalued relative to its peers.
Exactly. It removes human bias. However, the notes issue a severe caution regarding its limitations. This method relies entirely on the assumption that the empirical relationships captured in the regression are stable and accurately reflect fundamental value.
It assumes the market is right.
Right. It assumes the average pricing of the market is correct. But if the entire market is in a bubble, the regression will just tell you to buy slightly less overvalued bubble stocks. It also suffers from a omitted variable bias. If a company has terrible management, the regression won't know that. It only sees the numbers.
So the quantitative model is a powerful tool, but it can't replace the qualitative judgment of an analyst. So we've covered how to value a company today using multiples. We know how to compare it to its peers right now. But valuation isn't just about today.
No, it's about the future.
Right. When analysts build those massive multi-stage discounted cash flow models we referenced at the beginning, they face a structural problem. You can't project individual cash flows out for 80 years. It becomes an exercise in fiction. At some point, usually 5 or 10 years out, the specific forecasting has to stop.
This brings us to a crucial application of multiples in advanced modeling, estimating terminal value. In a multi-stage DCF, you forecast specific, detailed cash flows year by year during a period of high growth, say, the next 5 years.
Okay.
But in year 6 and beyond, you assume the company enters a mature, steady state. You don't project year 6, year 7, year 8. You calculate a single lump sum value representing the firm's worth from that point forward into perpetuity.
That lump sum is the terminal value. And the notes explicitly state that analysts frequently rely on price multiples to calculate this massive number.
It is the most common industry practice. The mechanics are relatively straightforward. At the end of your detailed investment horizon, you project the final value by taking an expected price, multiple, usually an industry average PE or EV/EBITDA ratio, and multiplying it by the forecasted fundamental variable for that distant terminal year.
Let's walk through that. Suppose I am building a 5-year model for a mid-sized tech company. I do the grueling work of forecasting their revenues and margins, and I project that in exactly year 5, they will generate an EPS of $4.
Got it.
Now I need my terminal value. I look at mature, steady-state tech giants today, and I see they trade at a PE of 15. I assume my company will command that same multiple in 5 years. So I multiply the $4 EPS by the multiple of 15. My terminal value in year 5 is $60 per share.
Yes.
I then discount that $60 back to present value today.
The multiple functions is a highly efficient shorthand for an infinite series of future cash flows. It assumes the company will reach a stable state where a standard, justifiable industry multiple is appropriate. However, you must be incredibly careful.
Why is that?
The terminal value often accounts for 60% to 80% of the total present value in a DCF model. If you use a multiple of 20 instead of 15, you drastically alter your entire valuation. You're placing massive weight on a single assumption about what market sentiment will be 5 years in the future.
It highlights how sensitive these models really are. Okay, we're entering the final stretches of the notes, and there is a practical math problem introduced here that I find absolutely fascinating, primarily because it outlines a trap that almost everyone, including myself, would fall into intuitively. It's about portfolio math.
This is a critical concept for anyone analyzing funds rather than single stocks.
Let's set the scene. Imagine you manage a boutique portfolio of 5 different stocks. Or maybe you are evaluating an ETF. You want to calculate the overall PE ratio of your entire portfolio so you can compare it to the S&P 500.
The intuitive, obvious thing to do is just take the PE of all 5 stocks, add them up, and divide by 5, right?
Right. You take a simple arithmetic mean. Why doesn't that work?
If you do that on the CFA exam or in a professional investment committee meeting, you will be deeply embarrassed. Using a simple arithmetic mean for price multiples is mathematically broken. It creates a severe and misleading upward bias.
I need you to break down the math of why it fails. It seems so logical to just average them.
The failure stems from the fact that PE ratios are fractions and they are highly asymmetrical. The numerator, the price, can theoretically rise to infinity, creating massive PE ratios. But the price can only fall to 0.
Okay, I'm following.
To see the trap, let's use a very extreme 2-stock portfolio. Stock A is a stable value stock. It costs $10 a share and it earns $1 a share. Its PE is a very normal 10.
Got it. Stock A has a PE of 10.
Stock B is a speculative tech stock. It costs $100 a share, but it only earns $1 a share. Its PE is a massive 100. Now calculate the simple arithmetic mean of those two PE multiples.
Okay, I take 10 at 100, which gives me 110. Divide by 2. The arithmetic average PE of my portfolio is 55. That sounds, well, really expensive.
It sounds expensive because it's mathematically wrong. The arithmetic mean overweights the extreme outlier. To find the true PE of the portfolio, we have to look at the underlying cash flows. Imagine you bought exactly 1 share of each. What was your total out-of-pocket price?
I paid $10 for stock A and $100 for stock B. So my total portfolio cost, my total price is $110.
And what are your total portfolio earnings?
Stock A earned $1 and stock B earned $1, so my total earnings are $2.
Now calculate the true PE of the portfolio. Total price divided by total earnings.
$110 divided by $2.
Yeah.
That's 55? Wait, let me rethink the weighting. If I put an equal dollar amount into both?
Yes, let's do equal dollar weighting, because that's
you-
how an index typically works. You invest $100 in stock A and $100 in stock B.
Okay, equal weighting. I invest $100 total in stock A. Since it's $10 a share, I buy 10 shares. They earn $1 each, so my total earnings from A are $10. I invest $100 in stock B. It's $100 a share, so I buy 1 share. It earns $1. Total earnings from B are $1.
Perfect. Total investment.
$200.
Total earnings.
10 plus 1. $11 total earnings.
Now do the portfolio PE.
Total price of 200 divided by total earnings of 11. That is 18.18.
Exactly. The true economic PE of your equally weighted portfolio is 18.18. But earlier, the simple arithmetic average of the multiples 10 and 100 told you it was 55.
Oh.
The simple average was wildly, dangerously wrong. It created a massive upward bias.
That is mind-blowing. The simple average told me my portfolio was wildly overvalued at 55, when in reality, the true economic ratio of the cash I spent to the cash I'm earning is a very reasonable 18.18. So what formula are analysts supposed to use to avoid this?
The notes dictate that you must use the weighted harmonic mean.
The weighted harmonic mean. The formula printed in the book looks like something out of advanced physics.
The algebraic notation is dense, but conceptually, it's doing exactly what we just did manually. The harmonic mean corrects for the asymmetry by essentially averaging the yields, the EP ratios, which scales them properly, and then flipping the final result back over.
Oh, that makes sense.
It ensures that the total portfolio price is accurately scaled against the total portfolio earnings. Understanding this is essential for anyone evaluating ETFs because the published PE of a fund is calculated using this specific mathematical method.
It is a stark reminder of how easily numbers can lie if you apply the wrong formula to them. Okay, we have covered an immense amount of quantitative ground today. We've scrubbed earnings, we've discounted cash flows, we've run regressions.
It's been a marathon.
It really has. But I want to wrap up our deep dive with a concept from the text that acknowledges a totally different reality. Because up until now, we've treated the market like a giant hyper-rational calculator. But we know the market isn't a calculator. Often, it's a mob. It's driven by psychology, fear, and greed.
Yes. The notes conclude by moving beyond fundamental value and introducing momentum indicators. Because sometimes value takes a long time to be recognized, but momentum is happening right now.
These indicators compare a stock's price or return performance over a given time period, either against its own historical performance or against a group of peer stocks. I often hear traders call this relative strength.
Relative strength is the core metric of momentum. If a stock is persistently outperforming its sector index day after day, week after week, it exhibits high relative strength.
But if we've just spent an hour proving that value is based on cash flows and book values, what is the economic rationale for momentum? Why does a stock keep going up just because it's been going up?
The rationale provided in the notes is rooted in behavioral finance and market mechanics. Patterns of persistence or reversal may exist in stock returns due to several factors. First, information disseminates slowly. If a company has a massive fundamental breakthrough, it takes time for every institution to analyze it, upgrade their models, and buy the stock. This creates a persistent upward trend.
Makes sense.
Second, investor psychology. The fear of missing out drives capital into assets that are already rising. Third, institutional buying is lumpy. A massive pension fund can't buy 1 million shares in one day without spiking the price, so they buy it slowly over weeks, creating persistent upward momentum.
So things that are in motion tend to stay in motion, at least for certain observable time horizons.
Correct. And this is crucial for a complete analyst to understand. Even if your fundamental EBITDA models tell you a stock is dangerously overvalued, if its momentum and relative strength are off the charts, it might be financial suicide to short it today.
Wow, yeah.
Market-based valuation requires acknowledging not just what the fundamental value should be, but what the market is willing to pay right now. Momentum respects the reality of the trend.
That is an incredibly comprehensive framework. Let's synthesize the utility belt we have built today from R22. If you've been following along, you now have the tools to look past a flashing stock price and see the structural architecture underneath.
You're ready to dig in.
You understand the PE ratio for measuring raw earnings power, and you know how to scrub the income statement to find underlying truth. You have the PB ratio for valuing the hard liquid assets on a bank's balance sheet. You have the PS ratio to find unmanipulable revenue growth in startups while remaining wary of margin compression.
The unedited camera roll.
Exactly. You have EBITDA for calculating the total debt-inclusive acquisition cost of an entire enterprise. You know the fundamental math driving these multiples, and you know how to avoid the catastrophic arithmetic mean trap when evaluating your portfolio.
It is a robust toolkit used diligently. It provides a massive analytical advantage in the market.
But as always on this show, we want to leave you with something to chew on, something that takes everything we just learned and tilts it slightly, forcing you to look at it in a new light.
We have spent this entire session meticulously calculating justified multiples. We talked about how they are driven by current fundamentals, expected growth, and crucially, the required rate of return. But consider this macro reality. If all these perfectly justified, mathematically rigorous multiples rely heavily on the required rate of return, and that rate is fundamentally dictated by macroeconomic interest rates set by a central bank, does that mean a committee of central bankers deciding to hike rates by 50 basis points can instantly turn your perfectly modeled undervalued stock into an overvalued one overnight without a single thing about the actual underlying business changing?
It is a sobering thought, that X-ray machine we talked about at the very beginning. Sometimes the image changes not because the bone moved, not because the company faltered, but because someone sitting in Washington changed the frequency of the light. Thank you for joining us on this deep dive into R22. We hope you look at the market with these new lenses, check your multiples carefully, and we will see you next time.